Welcome to Blind Bankers of India. The videos uploaded on this channel are recorded for educational purposes. These are specially designed for persons with vision impairment. Press the bell icon to subscribe to our channel.
Hi friends, this is Ajay Minocha, and today we'll talk about the foreign exchange and some of its mechanics, foreign exchange markets basically. So what is foreign exchange and why do we need it? Basically, because of globalization, because we live in a global economy, and not one country is self-sustainable in a way that no one goes out, no one comes in, no one orders anything from outside, and no one sells anything to outside. That is not the case, which means we export to other countries, we import things from other countries, we travel, we also host tourists, and we borrow from another countries, we lend to another countries, which then makes us, deal in something called foreign exchange. So what is foreign exchange? Basically, for a person living in one country, the currency of all other countries is foreign exchange. For example, for us Indians, USD, GBP, Euro, they can be foreign exchanges. And similarly, for Americans, INR is a foreign exchange because USD is their domestic currency. So that is the need of foreign exchange because of imports, because of exports, capital flows like borrowing or lending, or say you have tourists and you also go to another countries to work for leisure, etc., etc. So that's why it's needed. And whenever you transact in another currency, be it buying something in US dollar, which can be also called as import, or paying someone outside your country for any purpose, or selling something to someone and receiving US dollars or any other currency, or receiving money from someone like remittance. If someone's staying in US, sends some money back home to his family. So then you are conducting a foreign exchange transaction. So basically, what is foreign exchange rate then? It is the rate of one currency equals to X number of units for another currency. So for us, say USD/INR, which means with USD, which is above slash, is 1 unit, and INR, which is below the slash, is, say, if it is 68, then we need 68 rupees or 68 units of rupees, which is same, to buy $1 in the market. So now let's talk about the participants in foreign exchange market and how the foreign exchange market is organized. Basically, it's not a physical market. It's something virtual kind of a market where a person can trade from the network sitting wherever he or she is, which can be through a mobile device, through a computer, through a telephone call, or directly also by going to a bank or money changer or any other relevant entity. So if we talk about the major participants in foreign exchange markets, those can be central banks, like we have RBI in India, we have Bank of England in England, we have the Fed in US. So all these banks, basically, they have the biggest task, which is to manage the exchange rate of their country Suppose if INR is going down, which means a lot of people are selling INR, then RBI will step in to buy some of it so that the exchange rate does not go down very drastically. We'll discuss about this in the relevant topic again further in this chapter. Then you have other commercial banks which can trade for their clients as well as for their own investments. Then you have other investment corporations, which can be mutual funds, traders, or arbitrage people who exploit arbitrage. What is arbitrage? I'll definitely explain after we are done with this. So their objective is just to invest or make money out of foreign exchange markets. Then you have companies which trade in foreign exchange market, one, to invest as well as to hedge. Hedge means to basically lock in some amount of rate for their foreign receivables or for their foreign payables, so that they don't get any surprises if the currency is very volatile, as in if the rate goes too much up or too much down. And then you have, of course, individuals. Someone wants to go to a foreign country, the person will buy foreign exchange, which is known as, he'll be selling Indian rupee and buying the foreign exchange, be it US dollar, be it British pound, and vice versa. Someone who wants to come to India. It would be surprising to know that almost 98% of the trade which is done in foreign exchange market is not done for trade or need purposes. It is mostly done for investment and hedging purposes. So there are a lot of people, we make money out of foreign exchange markets. There are a lot of companies, banks, investors who make money out of foreign exchange markets as well. So I promised I will explain what arbitrage is. Arbitrage is basically to exploit price anomalies. Basically, suppose if you went to buy 1 kg of potato, shop A sells it for 20 rupees, shop B sells it for 25 rupees. You're like, okay. And in your area, you don't have any shop. You will buy from shop A and you will sell in your area to a person called C. Then they will be like, okay, you can sell it for as much as 25 rupees. Assuming that other persons don't know about shop A, which is selling it for 20 rupees. So you can sell as much as 25 rupees, but you are selling it for say 23 rupees. Which means you're also earning 3 rupees in that transaction. So then other people will realize that, okay, shop A is selling for 20 rupees and this guy is selling for 23 rupees. Then they will say, okay, he's cheating us. We'll go to shop A to buy potatoes. We won't go to shop B and we won't go to you, as in the other person, they won't come to you also. Which will in the end make the price of potatoes equal 20 rupees or whatever they set. So basically, to exploit price anomalies, suppose one currency like India is quoting US dollar rate as something else, another country is quoting US dollar rate as something else. So what you will do to exploit the arbitrage? You will basically first buy the other country's currency and then buy US dollars and then sell US dollars in Indian market if India is quoting a higher rate, or any other fourth market. So to avoid that, exploitation is known as arbitrage, and to avoid that, you have free capital flows where the capital has to flow freely without any government restrictions, and then you don't have price anomalies. So now let's look at some of the characteristics of foreign exchange market. So it is basically a 24-hour market, which means it operates across time zones. Say, firstly, you have Asia Pacific and Australia, like Singapore and Australia, Hong Kong. Then India opens and Middle East. Then London also opens up. Then Singapore closes, Middle East closes, India also closes. Then by that time, US opens up. Then London closes. Then afterward, US also closes. By the time US closes, Singapore opens again. So that's how you know. That's how you say that it's 24-hour market. It is over-the-counter market, which means the dealings are customized. Over-the-counter, which means there is no standard deal. They are customized according to a person's need because the volume is very, very high. So this is basically a global market with no specific locations, which we have discussed earlier, that you don't need a location, you can trade through any device. So this market supports a large capital and trade flows. That's why it's a very big market, and that is the reason why, because of the flows, it has to give a lot of other facilities like 24 hours open and everything else. It is highly liquid, again, because of the previous reason, because it has very large capital flows, then it will be liquid. Liquid means you will be able to find a price for one currency to be exchanged by another currency. It won't be very difficult. So then you have high fluctuations in currency rates. I won't say every second, every less than a second, the currency rates are changed according to demand and supply. Millions of orders are getting placed every second. So the systems, according to demand and supply, they are very complex systems. They adjust the rates accordingly. So the settlements are affected by time zone, which is explained previously. Like every country has a different time zone. And of course, since it's a very big market, lot of capital flows, lot of money is involved, then it has to be heavily controlled by the government to avoid any situation like arbitrage, anomalies, or simply because they want to protect their exchange rate. So, what are some factors which impact foreign exchange markets? Those can be grouped in three categories: fundamental, technical, and speculative. Speculative, which is what arbitrage, which we talked about previously. So, fundamental is basically this is something because of which you can explain with a reason. That is something known as a fundamental factor. So those can be balance of payments. If your country has a huge balance of payments, which means you export a lot, but you import very less. You have a lot of foreign currency, which you can sell in the open market. If you can sell foreign currency, say you have a lot of USD and you can sell it, which means you can buy rupee. If you buy rupee's price will automatically rise against US, which means USD will fall. If USD is selling at 68, if you sell huge amount of USD, if you are sitting in India, it might go to 67. So balance of payment. Then you have economic growth. Generally, if you have high economic growth in a country, people will import a lot of things, luxurious items and other capital goods and this and that. So then, which require them to pay for those services and goods in foreign currency, which means they will have to buy it. So domestic currency, like if India has good economic growth, then India's currency might go down. Then you have fiscal policies, say taxes, government grants. So if there are low taxes or high government grants, which means government will give you more money to spend. More money to spend means more economic growth. More economic growth means your currency will depreciate. The price of rupee will go down, USD will go up. Then you have monetary policy, like say, you must have heard of RBI injected liquidity in the system, which is nothing but, as I explained it previously, governments themselves do a lot of buying and selling in the foreign exchange markets, and there are interest rates as well. So if there are high interest rates, your capital will flow into your country, foreign capital will flow into your country, because if a person is earning 2% in US and he's earning 4% in India, he'll convert it to Indian rupee and invest it in India, no? So to take advantage of that, he'll have to buy Indian rupees, which will drive rupees price up and USD price down. And then you have political factors, say government has a psychological binding. We will not let rupee go beyond 75 rupees. USD/INR go beyond 75 rupees. Then they will do lot of things to protect that. If it is going, say, to 76, because a lot of people are selling rupee and buying US, they will start buying rupee and selling US to counter that mechanism. Then you have technical factors, like a lot of government put capital restrictions. Like you must have recently heard that if investments are coming from China, they need a lot of approvals and stuff. So if there are capital restrictions, if there are more capital restrictions, less amount of foreign capital will flow in your country, which means your currency will not be demanded much. There are not many people who are investing in your country, which can drive the price of your currency down as compared to the other currencies. Then you have surplus, which is nothing but the surplus of payment. Then the third thing is speculation, which I have explained earlier. Arbitrage. If I'm speculating, okay, arbitrage is one part of speculation. The other part is, say, I'm betting tomorrow RBI will buy X amount of US dollars, which means if it will buy US dollars, USD will go up and rupee will go down. So then I will buy US dollars today. When RBI buys US dollars, US dollar will go up. I will sell US dollars, and that is known as speculation, or simply arbitrage. I am buying one currency, exchanging in another, and exchanging in another, or buying from one exchange and selling it to different exchange, just to exploit the price difference. That is known as speculation. Now let's talk about exchange rate mechanisms. So you have different type of deliveries. Basically, first is ready cash, where you get the funds of the delivery on the same day. Then you have TOM, which simply means tomorrow, which means you will get the delivery at next working day, and that has to be a working day for both the countries. Then you will have spot, which means T+2, which means the second working day. So suppose you have placed an order on first, you will get the delivery on third. Then you have something like forward. Forward is simply the predefined number of days after which you will get the delivery. Suppose I sign a contract with one company that after 1 month I will sell you $100 for 75 rupees each. That is known as a forward. And then after, if the contract duration is 30 days, then after 30 days we'll exchange the money. So now let's talk about the bid and ask rates first. What is bid and what is ask? ask is basically that much price I am asking for giving you 1 unit of a currency, and bid is I am ready to buy this 1 unit of currency in exchange of X number of other currencies. So basically, if a bid price is always lower than the ask price for someone who is trading in the foreign exchange markets. Why? Because the dealer has to maintain his margin. He will buy high and sell low. Buy high as in he'll buy high from the someone who is the seller, and he'll sell low. Apologies. He'll buy on the lower price and he'll sell on the higher price. So bid when the dealer is buying and you are selling, that will be always lower, and ask will be higher. So suppose if USD/INR is quoted as 68.10/11, which means the bid rate for USD/INR is 68.10, which means that if you are selling USD, you will get 68.10 rupees, but if you are buying USD, you will have to pay 68.11 rupees. Then you talk about forward rate. So forward rate is nothing but after say some amount of days, how much will that currency cost, which is determined by adding or deducting premium and discount from the home currency. So suppose if USD/INR is 68.10/11 and the forward rate forward premium is 40, then say 40 paise, then it will be the forward rate would be 68.10 plus 40 and 68.11 plus 40. So forward bid will be 68.50 and ask would be 68.51. So in that case, the currency which becomes expensive. So here in spot you are paying 68.10 for 1 USD, and now in say after 3 months you have to pay 68.50 for a USD, which means USD has become expensive. Then USD is trading at 40 paisa premium to INR, whereas INR is trading at discount to USD in the forward market. Usually whenever the rate is quoted, it is always quoted for a spot delivery, which is known as T+2, and for forward you need to have forward premium or discount. If suppose it would have been a 40 paisa discount in the earlier example, then the USD/INR would become 67.70 and 67.71 bid and ask respectively. Then you have like forward price calculation, where you actually figure out how much is the premium or discount on a pair of currency to avoid any arbitrage. So for example, if the interest rate in US is 2% and in England it's 4%, people will take USD, borrow USD for 2%, invest in England for 4%. So they will have to first borrow USD if they are sitting in US, for example. Borrow USD, buy GBP, which is pound, to invest in England. Invest that on 4% of interest. Then again sell pounds to convert the investment in US dollars, bring it back, and then pay back the loan, which is your original amount plus 2% of interest, and you will pocket the rest 2% which you have earned. To avoid that, there is a calculation of this zero arbitrage forward price. Then there is something called direct and indirect quotes, where the home currency or unit of home currencies are variable and foreign currency is fixed. Suppose USD/INR is 68.10. So which means, and then it becomes 68.15. Here USD is constant. USD is only 1. But INR is getting fluctuated, which is known as a direct quote. Then you have GBP/USD 1.855, which is 1 GBP equals to USD 1.855, which is an indirect quote for US markets, because here USD is something which is getting changed and GBP is stable. So generally Euro, Australian dollars, New Zealand dollars and GBP, their rate is quoted as indirect. Rest all rates are quoted as direct. So what do we do if we have to sell rupee and buy pounds, but we don't have a direct quote for pounds available? We have USD/INR and GBP/USD. Suppose USD/INR is at 70 and GBP/USD is at 1.1. We will cross both the rates, which means we'll multiply both of them, 70 into 1.1, which will become GBP/INR. So in that case, we'll first, suppose if we want to buy GBP, we'll first buy USD against INR, then we'll buy GBP against USD, which means we'll sell rupees, buy USD, then sell USD and buy GBP. That's how it is done. And then you have something like a fixed and a floating exchange rate. So fixed exchange rate is when a government fixes its currency against one other currency, that you will have to pay $75 or 75 rupees for $1, which is fixed, and then it is not fluctuated. But in the practical world, it was not becoming possible because of increasing globalization and stuff. So then in say early 1970s, the world moved to floating exchange rate. Floating has also its own variations, where say the currency is allowed to move between a band, say between say USD/INR will not go beyond 70 to 75. It will go beyond 75. The government will come immediately to buy rupee to make it 75, and it will go beyond 70. Below 70, the government will immediately come to sell rupee to make it above 70. So generally, in the practiced world, we have something like a free floating exchange rate, where the exchange rate is allowed to move freely with certain government interventions, which are generally not known publicly as such, but governments have their own target as to what amount they want to maintain their currency at. So they come to via RBI or via their own operations. They, say in India's example, they come to stabilize the currency market and their own domestic currency. So every branch and I would say every big corporation which has sufficient foreign exchange exposure will have a separate dealing room for foreign exchange. They will have something like a back office which will process orders and keep track of all the entries, all the ledgers. They'll have a middle office which will look about various risks and other oversights. Then they will have something like a front office which will actively trade in the market. So you need very dynamic individuals who can work under pressure. I know it sounds like a classic CV quality, but yes, the money involved is huge, so you cannot lose your calm, and you have to work a lot of times under pressure if you are trading into foreign exchange, and of course with an analytical mindset plus extreme accuracy, because even 0.1 paisa difference can make huge dent in your final day's profit and loss. So let's talk about some of the risks in the foreign exchange dealings, which can be first is operational risks, which is because of some lack in your operations, which can be technical or human error or any other error, because of which the organization suffers a risk, a loss. Then you have exchange risk, when you have your assets and liabilities mismatch, where you entered into one deal at one rate and suddenly the rate changed and now you have to pay more. Say you entered into a deal when USD/INR was 68.1, then it immediately became 68.5. So when you have to say if you have sold USD earlier and now you have to buy, you'll have to buy at a higher rate, which will be again a dent. Then it is credit risk, which is basically when another party owes you, when you have given your money to someone, be it in trade or be it anywhere else where you have a receivable and you have a right to receive the money, but the other party fails to pay it, which is of course like a bad loan in a general term. Then settlement risk is basically it's a niche kind of risk where there are multiple dealings involved. One party does a dealing and it abides by its rules, and then say you have closed your office, the other party is sitting in US. By the time their office opened, you closed, you are done with your leg of contract, but the party sitting in US might not be able to do, and you won't get to know unless or until their market open up. Of course, with 24 hours open market now across different zones, these are largely negated. Then you have liquidity risk, where you have more things to pay than to receive. Say you have to pay £10,000 for a delivery and you have only £9,000 in your receivable, which means it's a liquidity crunch. You don't have enough amount of money to pay. So how is it different from credit risk? In credit risk, the one from whom you have to receive the payment, that person defaults, but liquidity risk is when you find it difficult to pay the other party. Then interest rate risk is basically if you borrowed at 8% and invested it at 10%, and suddenly in your home country the interest rate is fluctuated to 11%. So, but in your destination where you have invested, it is still 10%. So then you are actually at a loss where you have now borrowed at 11% and you are still earning 10%. So that is known as interest rate risk, where the interest rates mismatch. Then you have a legal risk where your contract or your validity of contract is challenged in the court of law. Then you have systematic risk where you have a system failure. System is not known here as IT system, it is known as the financial system, where one bank fails and because of which you find it difficult to pay to the other counterparty, or the other counterparty finds it difficult to pay you. Then you have some standard RBI or FedI guidelines. It is more theoretical and less conceptual, which I recommend reading it from the book because guidelines are prone to change. So even if I explain it here, or if I recite those here, those may change subsequently and the guidelines may become obsolete. So I recommend reading it through the course book, the latest set of guidelines of RBI as well as the FedI, which is Foreign Exchange Dealers Association in India. So let's talk about some examples here. If there is a customer who is an exporter, and I am a bank, I have a customer who is an exporter, and he has a receivable of USD 100,000, which is USD 1 lakhs, and the market bid/ask rate is 68.09/11, which means bid is 68.09 and ask is 68.11. So let's spend here some time on explaining as to how will the mechanism look like for the customer as well as for me, as in the bank. So if the customer is an exporter, the customer will receive money in USD, which he or she will have to convert in rupees. And if he has to convert it in rupees, then he has to sell USD, which he has received, and buy rupee. If he is selling USD, which means I am as a bank buying USD, and I will buy or sell at the market rate and bid and ask rate. So according to what we have explained earlier, I as a bank will always buy low and sell high to maintain my margin. So in that case, I will tell the customer, you can get rupees, or you can exchange your 100,000 USD in rupees at the rate of 68.09, which is lower between the two, which is the bid rate at which I am ready to buy USD from the customers. Of course, if I have my commission or margin, I will then deduct this from the final proceedings of what I actually offer. Which means if the margin is say 1%, I will first calculate 1% of 68.09. I will deduct that margin, and then whatever the final figure will come, I will tell the customer the final rate looks like this. You pay me this much amount of I'll pay you this much amount of rupees in exchange of your 100,000 USD. Next example, on 3rd October 2016, my exporter customer tenders an export bill for USD 500,000, which is USD 5 lakhs, drawn 120 days. Please note that this is a forward transaction from the date of shipment. So now we have to compute applicable rate, presuming exchange margin of 0.15%, spot rate of USD slash INR, which is 68.14 slash 15. Premium, which is forward premium for 120 days, is 45 slash 46. Rate to be quoted to nearest 0.25 paise multiple, which is a finer calculation, which I think for the ease of understanding we can ignore, and it is unlikely to be featured in exam to round off, because it's something which is best done with a computer. So this rounding off we can probably ignore for this. And next point is applicable interest at 8.5% for export financing, and commission on bills purchased at 0.0625% to be charged upfront. So now we have to quote an all-inclusive rate to the customer, which is keeping all our margins, interest, commission, forward premium in line. So first, let's calculate the bill buying rate. We'll take the spot rate. We'll deduct the margin. Remember in previous example, the customer was exporter, and I told you we have to deduct the margin while we are buying from a customer, because then we'll have to pay less. That is again a kind of commission. Then we'll add the premium, which is the forward premium, which is given in the question. So which is, we'll first take say 68.15, which is the original rate, spot rate. Then we'll deduct the margin, which is 0.15%. Then we'll add, there was 45/46 premium, which meant 45 is for bid and 46 is for ask. And here we are concerned with the bid price, because we are buying from the customer and customer is purchasing. No, customer is selling to us. So this is a bid price. So we'll add 45 here, the lower of the two, which comes to be something around 68.48779. I calculated this in Excel, and I have rounded it down, just 68.4875. So as I said, calculation is more important. Concept is more important here than calculation, which you can easily do on using your abacus or even a simple calculator. Basically, to calculate the forward rate, we first took the spot rate. If we are buying from the customer, which means the customer is selling, the lower of the two, we further deducted the margin. Then we added the forward rate of say 120 days. How do we arrive at a forward rate? Which was the premium point which were given, like 45 paisa for bid, 46 paisa for ask. We added 45 paisa in that, and then we rounded it down to nearest multiple of 0.25. So now focus back to the question. How much is the final amount which we'll pay to the customer in INR? We'll pay to the customer because the customer will, after 120 days, sell us USD at the rate of 68.4875. I guess I'm pronouncing the rate correctly. So he'll sell us at this rate, and if you're buying, we'll have to take another factors into account, like interest. We will financing something, so we'll charge the interest. So first, 500,000 into 68.4875, which comes to be somewhere around 34 million. Then we'll deduct the interest, which is at 8.5% into that 34 million amount into 120 by 365. Why? Because it's 8.5% annual, and our contract duration is only 120 days, so we'll do 120 by 365. Then we'll also deduct the commission, which is at 0.0625%. It also comes to at some amount, which I don't think is relevant as of now, but yes. So then after deducting interest and commission for our financing services, we arrive at the final figure, which is somewhere around 33 million, which we will pay to the customer. So please note that here we are actually doing two services. One, we are acting as a foreign exchange money changer for the customer, and we are providing export financing also. Like, suppose the customer has to receive the money 120 days after the transaction, but he's like, I need the money right now. So we'll say, okay, this is the forward rate which we have computed previously. So our money changer role is over. Now we are also facilitating the role of a bank. Like, okay, we'll give you this money right now, but we'll charge this amount of interest and this amount of our commission to give to the office person who will process it, the officer. So we'll deduct the interest also because it's an upfront payment. We'll deduct the commission and then we'll pay the final amount to the customer. Last example for the day, which says retirement of import bill for GBP 100,000, which is 1 lakh British pounds, with a margin of 0.2%. Then GBP/USD is 1.2175 / 1.2185, which is, it's actually written as 1.2175/85, which means 2175 is the bid, and then 85 if it's written, then 2185 is the ask. USD/INR is 68.14/15, which means 68.14 is the bid and 68.15 is ask. So now we'll compute the rate for the customer. So before we jump into the mechanism, here note the difference. It is import. Retirement of an import bill, which means the customer is importing something. So he has to actually pay in foreign currency rather than receive foreign currency. He has rupees. He has to buy foreign currency from us to pay to the counterparty or someone from whom he is importing. So in this case, if he buys, what happens? He is actually given the higher rate of the two, which is ask rate. I mean, that much amount of money we as a banker will ask from the customer for him to let him to buy GBP from us. So ask rate is higher of the two. Here you have GBP/USD and USD/INR. So once you have one currency below the slash and one currency above the slash, it is thumb rule that you can multiply them to get the final rate. So it was 1.2175/85 and 68.14/15. So you will take 68.15, the ask rate for USD/INR, and you will take 1.2185, the ask rate of GBP/USD. You will multiply the two, you will get the final figure. And before we go, remember, there is something called margin also. So in that case, margin previously you were deducting in the case of export. Why? Because the commission you will have to earn for yourself. So from export, when you are actually doing an export thing, you are buying from the customer, you will deduct that. Say you are giving rupee, you will deduct the margin. And now when you are giving the GBP, say foreign currency, to the customer, you are selling foreign currency, you will add the margin to further inflate the prices by 0.2% of that cross rate which you have previously got. The final amount will be basically GBP/USD into USD/INR, both ask amount, both the higher ones, plus 0.2% of the multiplication which we have obtained, equals to the final rate which we'll quote to the customer. So let's look at the last example of this chapter, which is again a cross rate mechanism, but this is slightly different. Here you have both the quotes as direct, where say USD/INR and USD/JPY. So basically you have a customer who has an obligation. He is an importer basically, so he has to pay a Japanese counterparty 100 million Japanese yen, which is JPY. So now you have to give him a rate. JPY/INR is directly not available, so you will have to derive this. So USD/INR in this case is 68.25/26, and USD/JPY is 116.5/6. So now, firstly, what you are doing, you have to first convert INR into USD and then convert those USD into JPY. So converting INR into USD means you are selling USD to the customer, and then you are selling that amount which you have got in open market to buy JPY. So now, if you are selling USD to the customer, you will quote the higher rate out of the two, which is 68.26. And then whatever proceeds you receive, you will have to tender those in open market. You will have to buy, this time you are buying JPY for satisfying the customer's obligation. So then you will get the lower rate out of the two, which means you are selling USD in a way. So that will be 116.5. So here to calculate JPY/INR, you will do 68.26 divided by 116.5, which comes out to be 0.585923. So now FEDI says one interesting thing. Whereas whenever a currency rate is very low, lower than 1 rupee, that FEDI says that, okay, you quote that currency into 100 unit equivalent to rupee. So now this is JPY/INR is 0.585923, which means what? 1 JPY is equal to 0.585923 rupees. So now they will quote it as in 100 JPY is equal to 58, or I would say 58.5923 rupees. Now, since it is an import transaction, you will add a 0.15% margin also, which comes out to be 0.9879. So the final rate comes out to be JPY/INR, for every 100 JPY, the rate comes out to be 58.6892. If you want to round it off, you round it off by 58.68. Total rupee amount to be debited to the amount to the counterparty would be multiplied by how much? You had 100 million. If you had 100 million, but you have already multiplied it by 100, you will multiply it by only 1 million in this case. 1 million, which means 10 lakh rupees. It was 100 million, which was known as, say, 10 crore rupees. You have already multiplied it by 100 to quote the rate to comply with the guidelines. Now you only multiply it by 10 lakh more and quote the final amount to the customer. Any questions? Please mention in the comment section below and I would be happy to answer those. Hope you would have liked the video. Thank you.